The Financial Survival Network, helping you survive and thrive in the new economy. Go to CarrieLutz.com and sign up for 30 free micro trainings on financial survival.
1490 WGCH. This is Carrie Lutz, and you're listening to the Financial Survival Network, which is brought to you by Miles Franklin. They've been in business selling gold and silver for over 20 years, and I'm a customer because when you buy, they ship. For more information, find them on the web at milesfranklin.com or give them a call at 800-822-8080 and get a free quote. We're back with Jason Burack, and we're talking about energy and gold prices. Jason's just written a paper on energy, on oil. A lot of solid info there. I'm reading it now. Jason, welcome back to the Financial Survival Network.
Thanks, Carrie. Glad to be back.
We're glad to have you so you can talk about what's happening in these precious metals markets and what's going on with oil and energy as well, because prices seem to be sinking in both of them, right?
Yeah, but I think it's for somewhat different reasons here. I think the gold and the silver price, a lot of the selling pressure, it's just been so enormous for about a year now, I would say. And I think the selling pressure has just overwhelmed the buyers, especially in the futures markets. And I think it's been exhausted, basically. So I think we've definitely, from a psychological standpoint, I don't think there's a lot of people throwing in the towel here, a lot of even professional people and, long-term precious metal bulls who are starting to give up. So I think this normally signals the bottom here. In terms of technical stuff, it broke the 1600, gold broke the 1600 support level. Mm-hmm. And we have some pretty strong support around 1575 still, but after that, it might go a little bit lower here. So this is why for well over a year now, and I've said this in all my interviews on here and all my interviews elsewhere, that people needed to keep a cash position for an event like this. And this, that you want to have the cash, you want the liquidity, so you can say, well, the market just handed me a gift and I have cash, and my precious metal shares or my physical bullion is at a big discount now, and it's time for me to buy some more. So I don't know if people should go all in here at these levels. I know some very aggressive, some professional investors and traders who are going all in at these levels with leverage. But for most people, you got to be able to sleep at night. So if you have cash flow coming in, if you have a job, if you have a certain amount of cash on the sidelines, I think now would definitely be a smart time to use it.
So buying opportunity is here, and it's always when blood is running in the streets that these opportunities present themselves, right?
Exactly. And for most people, and this is what separates the really, really good from just the average or the bad investors. And most people can't deal with this panic and this pain. And they plan, from some of the people I've been talking to, they just plan on their gold and silver positions. If they get back to even, they want to sell. And that's not how you make money in the markets. It's just not. Yeah,
definitely not.
And you don't want to be doing that. You want to be buying, even if you bought a stock and it's lost, 50, 60, 70%, but you've done your research and the company is having a really good earnings the last 2 quarters and the stock's still gotten crushed, I would put my money down here. And that's how I've made the big gains. I did this in a copper stock after copper crashed when the markets crashed in 2009. Mm-hmm. And I saw that the company was going to survive. And the copper stock went from 30 cents to over $5 in 18 months. So yes, it was very difficult. It was very mentally painful. I did my research. I did my homework. I did not go all in with all my, capital into this one stock, but I put as much as I thought I could risk forward to losing, and it paid off. And these are the types of things that separate the really good investors from the average ones or the really bad ones.
Yeah. And also, look, if you bought gold and silver 5-6 years ago, or you bought it at the bottom in 2008, early 2009, are you really worried?
Exactly. And the funny thing is that these stocks have, underperformed the bullion. The precious metals mine stocks have underperformed the bullion by over 3 standard deviations now. It's getting massively underperformance, massive divergences here. And there's a number of professional investors now, like an Eric Sprott type, who I think has come out and said recently that they're actually selling more of their gold bullion to go and buy gold stocks. Because for some of these producing gold stocks, and these are not the juniors that are years away from cash flow necessarily, I'm talking you can buy quality companies with very good earnings. The earnings have been spectacular recently for these companies, and the stocks just continue to sell off. It's just ridiculous. So for your listeners out there, you can pick up a 3% dividend yield stock in a Newmont Mining, who's a very profitable gold mining company. Their profit margins are still expanding pretty nicely. They're not getting killed by the energy input costs. And, you can just sit back there and wait with a 3% dividend yield. And if the gold price goes higher, say to over $2,500 an ounce, Newmont management has already came out and said that they're looking at increasing the dividend to 6%. So you're already ahead of the game in bonds. There's no reason to be in treasuries then.
Right. Makes a lot of sense, because you get paid to wait till it turns around, which is inevitable, because I know manipulation, a lot of externalities here, but in the final analysis, people go where the earnings are, they go where the value is, and once these stocks start going up in price, the herd will follow them up. That's the way it usually works, especially if they're staying even and the rest of the market is really getting slammed, which certainly is a definite possibility over the coming months ahead with all of the banking hits that are going to take place shortly, right?
Exactly, Kerry. And to add further to your point here about the leverage money and the herd coming in, this is what the majority of capital now on Wall Street has turned into. These guys are not buy and hold long-term investors. The majority of large pools of capital on Wall Street now are leveraged money. They're trend traders. They're high-frequency traders. You're seeing more and more capital go into those things. So those guys are not long gold and silver right now. These guys are not contrarians. They're not contrarians at all, in fact. So these guys are trend traders. So once gold and silver do turn around, these guys are going to hop on the long bandwagon and they're going to push the trend higher. So unfortunately, this is the way what the markets have turned into right now. And during this currency instability period with central banks interfering on a massive scale, the long-term buy and hold investor for the Warren Buffett style, it's just very difficult to do that anymore. And you really can't value the assets anyway because the currencies aren't stable. So then because of all these fluctuating currencies and all of these over-the-counter derivatives, you have these banks making stupid bets who think that they have their risk modeled properly and they don't. You have a blow up like JP Morgan.
Yeah, and what about that? What's the long-term results of what's happening now in the banking sector?
Well, I mean, the banks are basically an extension of the government. So all of the bank's stupid bets are 100% backed by the taxpayer. They're backed by the currency. They're backed by the central bank. The Federal Reserve, there's nothing to stop really the Federal Reserve from just printing up more money and handing it to Bank of America after Bank of America sold over $8 billion of naked credit default swaps on Greek debt and handing billions of dollars to JP Morgan after they made a bad bet. There's nothing to stop them from doing that. So, I mean, there's just no transparency in the banking system. Their assets are not being honestly accounted for properly. Their liabilities in the derivatives market are not being accounted for properly. They count net exposure in the derivatives market, but the problem with the net exposure as opposed to the gross exposure is that with the net exposure, if one of the other companies that's their counterparty risk were to default, it would set off a domino effect and it would just blow up firm after firm. So this whole net exposure thing that all these large banks talk about is really nonsense, because if one firm goes during this net exposure, all their net exposure model calculations are all reliant on every single firm paying out 100% of its derivatives exposure. It's not going to happen. There would be a chain reaction.
Yeah, that's something that Jim Rickards wrote about in Currency Wars, and you also saw it take place with Lehman. It triggered all those credit default swaps that they were on the other side of. So banks found themselves responsible for the gross risk, not the net risk.
Exactly. And this is also why, Kerry, the Federal Reserve is going to have to backdoor bail out the ECB, a lot of the ECB countries, they're going to pump money into the ECB, and then the ECB is going to distribute it to European countries, and it's going to get distributed to the larger European banks, because the larger European banks, they can't afford for one of those ones to blow up either, because the American banks and the American banks' European subsidiaries are all holding each other's bad paper, and they're all holding the government treasuries bad paper too.
It's a real unholy alliance that cannot end well for anyone, especially you, the taxpayer, you, the consumer, you, the working person who is watching the entire world's wealth squandered away by a bunch of sociopathic, compulsive gambling traders that work for these large institutions that are effectively a branch office of the government, but of which the government and the rest of us have no control over. Exactly.
And no one's holding them accountable at all. And the way the risk trades have been set up is that these guys, they're focusing on their bonuses in the short term, and they don't care. Most of these guys don't care about the risks of their long-term firm, which is not the way you run a business. If most of these guys are not good business people, because when you run a business, it's about maximizing. It's not about maximizing the short-term profit. It's about balancing short-term profits versus long-term investment, because you don't want to blow up your firm. That's not the point. You want to run a long-term business. You want your business to be around for a long period of time. So you have to manage the short-term risk versus the long-term risk, et cetera, et cetera. And I think this is why people on Main Street need to have at all times a certain amount of exposure to precious metals. And I think oil is also a very good hedge to your precious metal investments, because I'm very confident that over the long term, unless central bankers don't print any more money, oil prices are going higher.
Yeah, well, if they stop printing money, that would lead to major deflation, collapse of everything. So I just can't see that happening. It's kind of inflate or die, and it's the only thing they know how to do anyway. They don't really have any other tricks in their bag.
Exactly, and deflation is free market forces. That's a debt deflation, complete credit write-down, high interest rates, etc. And you're just not seeing that. You're seeing the central banks manipulate the interest rates lower. So there's the price signals are being distorted in the market. But one of the things that pretty much almost every single government wants is higher oil prices. Now, they don't want an oil price super spike where oil goes to $150, $200 a barrel overnight. No one wants that. But they do want, I would say, a 10% increase per year. They're trying to manage the oil market right now, where the oil price does go into a higher and higher trading range every single year, a certain percentage amount.
And why is that?
Well, governments benefit from higher oil prices. In our oil report that you talked about earlier, Kerry, one of the main things, and we have a very long section on this, is government intervention in the oil market. And governments make from in a tax foundation study, which was a pretty in-depth study that your listeners can go look at, and this will blow some people's minds, because the oil speculators on Wall Street and the big oil companies, they do make money off the current status quo in the oil market, but governments make more money. So from 1981 to 2007, from this tax foundation study, total all world governments, including OPEC countries and the United States and other countries that make money off oil royalties and other excise taxes and corporate profits taxes off oil companies, they made 40% more profits than the oil companies did. So this is ridiculous that when a politician or mainstream media person goes on the rhetoric, these greedy profiteers, blah, 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 blah. We do have price volatility in the oil market because of traders. That is for sure. And we do probably have too much paper oil. But governments make a lot more money off the oil market because they control the majority of world oil production. They control over 70% of world oil production, and they control over 90% of world oil reserves. So this is a government-controlled market, and they could basically, with changing the rules here or there, changing tax policies here or there, they can make the price go basically however they want for the most part.
Yeah, it's funny you mentioned that, because on the one hand, we have a government that says, don't smoke cigarettes. It's bad for you. It will kill you. And on the other hand, it's exactly the same as with oil, in that if everybody stopped smoking, the government would be bankrupt within a couple of months, or they'd have to print that much more money up to cover the losses from people who stopped smoking. So you really always have to follow the money to understand what the government really wants here. They don't really care whether you use how much oil you use. They prefer you use the same quantity, and that way the taxes go up. We have it here in New York. New York's the only state, or one of the few, that doesn't cap its sales tax on a gallon of gas. So if the tax comes out to, depends what county you're in, there's a whole bunch of municipal taxes. But if the price of a gallon of gasoline is $3 an ounce and the tax is 7%, they're making 21 cents a gallon. And conversely, if the price is $4, they're making 28 cents, which is a 1/3 increase in their cut on a gallon of gas. And effectively, it's higher than that as well. But that's what you always need to keep in mind, is that regardless what the government says, they always want their cut, and they always want their cut going up. So inflation is in their interests as well as the bank's interest, although not in your interests unless you play it right.
Exactly, Kerry. And I don't expect consumers to have relief for that much longer at the pump in terms of gasoline prices, because if the oil price does drop below 90, we have a lot of marginal production online right now, a lot of the world's oil production now, because we have the declining fields of the light sweet crude, which is a cheap and easy oil, and most of that stuff is gone. We have switched to a ton of higher production cost oil with the oil shale, with the Canadian oil sands, with deep water offshore, and enhanced oil recovery oil. So all of these types of technologies and new ways to get oil out of the ground, they're good, but their production costs are much, much higher than the old conventional way of onshore drilling a light sweet crude oil well that has a 10,000 barrel per day gusher. A lot of those wells, there are some of those wells left in the world, but almost the majority of them are all in geopolitically unstable countries. And those countries, some of them like Iraq, have those types of oil wells, and they're charging 90% tax on the profits. So if a Canadian junior wants to go into Iraq and help them, increase production in their light sweet crude, the government's going to take 90% of the profits.
Yeah, absolutely. No question about it. And that's what peak oil really means. It's not that we're running out of oil. It's that cheaper sources of oil are diminishing, becoming less available, or they're from geopolitically unstable areas of the world. Another reason to keep away from them. Anyway, Jason, hey, people want to learn more about you, what you're doing, and get this report. Where do they go?
They can go to our main Wall Street for Main Street website at wallstforminst.com. And if they want the oil report specifically, that should be out for sure in the next 10 days for sale. And they can just send me an email there through the website, and we'll put their name on a reserve list for the report when it's ready to be sent out.
Excellent. And we'll also put up a link once you have the report out so that people can easily get to it without having to remember all that. Okay?
Okay, great.
All right. Hey, thanks so much. Always a pleasure to have you on. We'll talk to you in a bit, and we'll see where these markets are heading. There's nothing really, how would I say? There's nothing that pleasing over the horizon, put it that way.
Yeah, I think the Fed, for my final comments here, I think the Fed has definitely managed the commodity price expectation here to the levels where they can get away with doing another stimulus or quantitative easing in the next couple months.
That's what it's all about. That's what I've been saying for the past month. Bad news coming. We're seeing the banks blow up, banks in Europe blowing up. The only way that they have to deal with it, short of closing them down, putting them into conservatorship, and recapitalizing, the only other way is write them checks. Create money out of thin air. There is no other way that they can deal with this. On that note, Jason, be well. Look forward to getting the report, and you take care.
Thanks.